Cash flow or capital growth? What's the perfect recipe to maximize your returns? So there's a lot of different acronyms and words used in property like yield, ROC, ROI, return on investment, and they all mean slightly different things. But actually, what is it you should be looking for to actually maximize the return on investment in your property portfolio? Well, there's a lot of different ways of making money in property, and most people think of CF, which is cash flow. For example, if you end up renting a property out for £750 a month, you might think, well, over a year, that's going to be £9,000, times in that by 12, which is the 12 months of the year. But actually, that isn't true. You've got your mortgage cost, if you've got it mortgaged. You've got your maintenance, your management, your insurances, and whatever it is. So it might end up being that you're actually getting £200 a month. And if you're getting £200 every single month, that's going to be $2,400 a year. Now, this is your net cash flow, but actually that's not how you make money overall in property. There's other ways. So the main one, I mean, you could talk about debt, you could talk about tax mitigation strategies, but the big one is CG, which is capital growth. And really, when you're purchasing a property, it's making a decision between the two. Now, let me explain what I mean. So just so we're clear, cash flow, or the net cash flow, is the net rental amount you are getting on a monthly and yearly basis. Capital growth is inflation in the value of the property. So if you buy a £100,000 house and there's 5% capital growth, it's gone up to £105,000 of value, capital growth. So where is the money? Well, this is where the perfect recipe comes into play. So as I said, it is a perfect recipe, and often what you're finding is if you've got your cash flow on the one side and capital growth on the other, then you're really getting a bit of a trade-off. So if I just give an example of this, if you have got low cash flow, you will typically have higher capital growth, and when you've got your higher cash flow on this side, you're going to have lower capital growth. So if I gave an example of the extreme on this side, you might say London as an example. If you buy a buy-to-let property in central London, you are very likely to have a very low cash flow, but historically, you're going to have really strong capital growth. Now, I just want to put a caveat in there for you, because some people go, well, actually, capital growth in London has been shocking over the last couple of years. It's like, yes, I'm talking about the next decade, 20, 30 years. If you go over here and you get some small mining village property in the northeast, now again, you might go, oh, actually, locations in the northeast have had amazing capital growth over a few years. Yes, but not historically. There's a reason you can pick up a property for 50 grand in the northeast and it will be 50 grand in 10 years time. Not knocking it, by the way, but you will find that if you purchased a load of 50 grand properties in the northeast, their capital growth will be incredibly low, but naturally the rents, even if they're only 450 a month, the cash flow versus cash in is going to be very high. So where is the happy medium? If you've got cash flow on this side, capital growth, you might go, well, I'm going to want to be here, I want to be here, I want to be here. And ultimately, it's all going to be down to your perfect situation. So for most people, I would be, let's say that's the middle there. Don't know why that rubbed out. Let's say that's the middle there. For me personally, I would want it around here. Okay, so if you think about, this is Old Kent Road on the Monopoly board, and this is Mayfair over here, I'm looking for the Vine Street properties. Okay, Vine Street, the oranges, the pale blues, that sort of level where you know it's in a decent area, you're getting a good price, but great rents in relation to the price as well. Let me explain it in real world terms. So let me just explain my logic in this. A lot of people think they're investing in property for financial freedom and to quit their job, right? Well, let's think logically about that. If you are doing that, you're going to end up playing in this area here, right? The cash flow section. But actually, how much money do you need? So let's say you've got a crazy investment and you're making a 10% net return cash flow, which, by the way, you almost definitely will not in property. But let's say just from your cash flow, you've got net 10% return and you need £50,000, let's say pre-tax here, in order to live. You want to retire, financial freedom. Well, in order to do that, you're going to need £500,000 cash invested, not £500,000 worth of property, cash invested at 10% to make you £50,000. Now, I'm going to make the assumption that you do not have that. Most investors do not have that level of money. Most of our investors will have about 200,000 to invest, okay? So when people are investing this, it's actually to supplement their income. It's to help towards a holiday each year. But more importantly, it's about legacy. And this is where capital growth comes in. So again, if we say these are the high cash flow properties, we know we're not going to get much capital growth. But what if we invested the same £500,000 where there's zero cash flow, or let's say £1, so at least it's not costing us anything, but we're in this really high capital growth area? That would be pretty cool, right? Well, maybe, maybe not. So you're not going to retire right now, but you're going to invest the same £500,000 in the highest capital growth area in the UK, let's say. So the highest capital growth area is usually about 12% a year, by the way. So that's pretty crazy. But that's not on the £500,000. That's going to be 12% on the value of the property. So in general, in property, you put in buy-to-lets at least, you put a 25% deposit down, okay? But 25% deposit, it's not quite like that. You've got some fees. So let's say there's 100 grand in fees. So we make that 400,000 and then we times the 400,000 by 4. So if it's 25% deposit, there's 75% debt, okay? So that 400,000 times the 4 is 1.6 million. So you've got 1.6 million that's coming in. And if we've got 12%, let's say 1% a month coming in, that is £16,000 a month, which is 1.6 million divided by 100. So 16,000 a month, which is 160, 32, 192,000 when you times it by 12. So the same £500,000 is getting £192,000 from that capital growth. The reason I'm saying this is people think that property is about quitting your job. It's not. It's not really about financial freedom in most situations. It's about legacy. It's about increasing your wealth and the preservation of wealth. So let me give you a real world example and why we focus on the Vine Street property. So you might go, well, if it's really making that much money, why not focus on the extreme capital growth? Well, the problem with that is it puts you at risk in the short term. So if you've got excess cash flow from your job, from your business, maybe you would take on a negative cash flow property. So a few people that I know that are not quite billionaires, but hundreds of millions, they will happily buy a property that they are losing tens of thousands on every single month for the capital growth. But they can afford that in return for the preservation of wealth, okay? And at that level, it's not worth going through in this video. They're also factoring in tax losses and tax breaks within that, so it really helps. But on a Vine Street property, let's say we purchased it for 120,000. It actually ends up at about 123, but I want to make this as simple as possible. So at 120,000 in my area, this is likely to be a decent capital growth area. In these areas, we will average about that 8 to 9% capital growth, but we're going to be more conservative with this example. So this particular property ended up renting at £700, just so you've got the actual figure. And the overall cash invested ended up being £49,800. I wish it was 50 to make it a lot easier for me, right? So we've got this. These are the actual numbers. So let me just put cash in there. So this is the cash in that went in. So if I break down the numbers, give or take on this, so you're going to have a 30 grand deposit in there, 25% loan to value. You're going to have stamp duty of 3%, which is 3,600. You've got some refurb fees, etc. And that's how we've come to this. It's not really a video about breaking down the intricate cost, but just so you know. But if we look at the actual returns here, so £700 per calendar month, we're going to times that by 12, which is going to be 8,400. All right, so we've got 8,400. But that is your gross. That's the absolute max that you get it in. But you're going to have to take off maybe, first of all, you're going to have mortgage interest. So 75% of this is debt. 75% of 120,000 is 90,000. And at the moment, you're going to pay about 5%. So you're going to have your, let's say, mortgage, I'll just put more there, of 5% of 90,000, which is £4,500. Then you're going to have management of that 8,400 at about 10%. I'll put man, which is 840. And then you've got about 5%, I'll put maintenance or main, 5%, which is another £420. So adding that together, you've got 5,760 in total. So if we're minusing the 5,760 from the 8,400, you're going to end up with 2,640. Pounds. That is your net rent coming in on an annual basis. So that's the cash flow. And you might go, do you know what? That's actually not bad. So I'll bring this up and just remind you. So you've got the 2,640. And in order to work out your return on capital employed, which is your ROCE, which is one part of your return on investment, you're going to divide it by the 49,800. Which, give or take, as a percentage, is going to be 5.3%. So this figure's ROCE. In general, by the way, a property that is around 5%, ideally around 5%, is what I'm looking for. Honestly, if it came out at 4.2%, it doesn't mean I would disregard it. It could still be a great property. But what about your capital growth? So we've got the ROCE, but capital growth, now on this particular property, capital growth has been over 10% every year since we bought it. But let's be conservative. Just so you know, the average is 7.9% in the UK, but I like to be conservative, let's say 5%. All right, so 5% capital growth. Now remember, capital growth is on the value of the property. So just a reminder, this property was £120,000. 5% of 120,000 is £6,000. So again, what we're going to do is the exact same equation, 6,000 over the 49,800, which, give or take a 0.0 something difference, is going to be 12%. Again, when you're actually doing this on your calculator, it will say 0.120 something. Just times it by 100, all right? So your capital growth is 12%. You might be going, yeah, but I'm not getting paid that. No, you're not. But as I said, property isn't just about cash flow. It's about your wealth. So what I like to do to work out my overall ROI, or what I call, and you might want to write this down, combined returns, is where's my money actually coming from? Well, most of it is in this capital growth, but there is stuff in the rental, and I do believe it's important to have a positive cash flow, which, by the way, rental increases go up over time. That number will keep going up. So will this, because it compounds. You've got a 17.3% combined return, or ROI. In my opinion, because people always say, what's the minimum that I would take here? The absolute minimum combined return that I would look at is 12%. If it's less than 12%, it's kind of like, I'm not 100% about that. The only time that I would take slightly less than combined return of 12% is if I particularly love the area, I think it's got some really cool stuff coming in, or I know that there's regeneration going on. So for example, in Leeds, the South Bank area has the second largest residential development going on in Europe right now. So because of that, I'd be happy maybe accepting a little bit lower. So look, it's all good talking about these figures, but how do you actually find these opportunities in the first place? Well, I'll be doing more videos on that, but you might be watching this because you don't actually have the time to find these opportunities, and that's where me and my company Aspire Property Group come in. So if you don't know, what we do is we find properties like this for investors, and we do it completely hands-free. So if you've got 100,000 or more that you're looking to invest in property, put APG in the comments, we'll send you a link, and what we'll do is we'll allow you to book in a free one-to-one strategy call to make sure this is right for you and we can help you build that portfolio. Hopefully you got value from this video. If you did and you're new to the channel, make sure to hit the subscribe and the notification bell. If there's anything you want clarification on, let me know in the comments. Smash the like button and I'll see you in the next video.